Okay, so the first one, which has come up here, which has come up quite a bit, and it's one for Adam actually, is can you differentiate between impact, ESG, and responsible investing?
It's working? Yes, it is. So responsible investing is the broad umbrella term, but more recently people have started to, I think maybe hold yours further away. More recently people have started to refer to ESG and responsible investing as very much the same thing. In my presentation, I probably referred to them interchangeably, but actually responsible investing is the umbrella term. Initially, we had negative screens, which were ethical investments, and those generally referred to exclusions when activities or companies involved in negative activities were excluded from investment portfolios. As I said in my presentation, ESG came around in the early 2000s, and that is more around what a company, how a company conducts its business. So. Negative screens is what it does, ESG is how it conducts its business, and more recently we have had interest in impact investing, which is really, echo's terrible, really looking at the the outputs. Is the company generating a positive impact from its activities?
Thanks. And so this has come up again quite a number of times, and I think it's probably front of mind from most people that are here. So the best way to frame this, and this is probably a question for Victoria if you want to take this one, and then Bradley, I think it's very relevant for you afterwards. Can you talk through the link between ESG and impact investing and performance? Is there a price to investing responsibly? And also, today's ESG funds tend to be full of growth style stocks. Is there a penalty for investing in that wake? And maybe let's go with that initially because there's a couple of follow-ons too.
So is there a price to pay? I guess because these tend to be, I mean, when the way that we think about it is a sort of growth coming from the impact that the company is generating. So as you say, there is a growth element to it. And if price to pay means just simplistically a higher PE, then typically these companies are trading at higher absolute PEs. Does it mean a price to pay in terms of sacrificing returns? I think the answer to that for me is no, if you're doing it properly. I think it's one of those things where investing in an impactful company on its own might not generate a lot of return, but I think if you're looking for quality companies that have that long-term growth, that are differentiated, having that active approach and doing the bottom-up fundamentals means you can differentiate the impact companies that do have that opportunity. And that's no different to any other form of investing. Will a value stock outperform? There are ones that won't. And so it's just doing that differentiation, I think. But fundamentally, impact companies have an opportunity to outperform that is driven by that secular growth. It's above market growth, a growth that fades at a slower rate. And that's not really different from a sort of quality growth style. It's just that the source of that growth is the sustainability opportunity.
And Bradley, following on from that, so clients are looking for responsible investments but are also after capital growth and capital preservation. How do you think they can achieve their investment objective in today's market?
Sure. I think,
it's on.
Hopefully you can hear me. I think the key is investors need to have a medium and longer term horizon. Over very transient periods, markets have big rotations. We've obviously clearly been through one right now. And the best sector, the best public asset class has been commodities. The dirtier the industry, the better it's done in the last 4 months. So for us, it's really about having a proactive, longer-term horizon and an approach and a discipline that balances risk and return. So long as you can do that, market cycles come and go. There tend to be moments where what one does doesn't work. And clearly, some of the clean environmental and higher growth companies have suffered more recently. But so long as you have a balanced approach that includes risk and return, that's nimble, not anchored, and is thoughtful, we have shown over time that we can create significant alpha for clients over the full market cycle.
And following on from that, for you as well, Brad, a lot of the companies in typical ESG portfolios are very tech heavy, but technology tends to replace people. What are your thoughts on employment, which must be one of the biggest social concerns?
Sure. I actually would disagree with that. I think if you look at the United States, where we have the best data, small startup companies disproportionately are the highest hirers of new people, particularly out of college. Over 50% of the new job creation comes from companies, and those are primarily in the technology space. Clearly, they are asset-light businesses. They are primarily dependent on their employees, and so those are the generators of disproportionate job growth. And if you look back towards COVID, Amazon added the most employees in a year than any other US company, about 1 million employees. Many of the companies that benefited from COVID were very aggressive hirers in the technology space, in the service space, be it food delivery, be it software coding. So my view is we've got to grow in order to create jobs, and growth now is very much dependent on human capital as opposed to asset-heavy industries.
Any from the floor? Here we go.
Probably more for Victoria. Just in terms of your opportunity set, are you finding that you're getting like a broad range of different sectors, not just sort of tech or agriculture?
Yeah, within the portfolio we have 9 themes. 5 of those are environmental and 4 are health. So there's a good amount of diversification across sectors. There are obvious skews in terms of what we don't invest in. So there's obviously zero energy. Web doesn't have any financial exposure, but there are impact funds that think about access to finance as one of their impact themes. So financials could be part of it. But there are skews, and we are overweight industrial, we're overweight healthcare. I think we're marginally underweight technology just because it's so big in the benchmark. But what it does is it moves you away from probably some of the mega cap FANG type stocks because we don't really consider those impactful. But I think there's still a good amount of diversification, particularly once you go down to the company level and look at the end markets they're serving, you get a lot of breadth. So for me, diversification isn't an issue with an impact as long as you're comfortable that it is skewed away from obviously fossil fuels, but some of the mining companies and potentially the big banks type of businesses as well.
Any others on the floor? One for you, Victoria, which I think is a great question. Can you be an impact investor and a value investor?
You can try. there are impactful value opportunities. They are fewer than growth opportunities, I would say. But I think there is certainly, I think it would be just a different type of impact fund. But I think the valuation is sort of separate to the argument. There are probably areas where there's room for improvement in these impact companies, maybe some that are challenged but have some reason for future success that might not be recognized. We don't have a lot of deep value in our universe that we've identified, but it's not to say that you couldn't do it. I still think there would be, given the impact, similar to what you were saying about the time horizon, there is a tendency for impact to be measured more across longer time horizons, and value investing, typically once the value is played out, you would sell it. So I would still probably look for value businesses that have a reason to hold on to them beyond that value thesis playing out. But I don't think they're necessarily mutually exclusive, no.
Adam, not just a pretty face. I suppose more broadly for our business, what regulations and framework or measurements are we most concerned about, do we most want to align with, or even how are we benchmarking the funds in the suite with relation to ESG and ethical?
Look, I think what's key is that we understand the regulation when it comes out, and there is an Australian-specific taxonomy that is in the works at the moment, which is going to provide a critical foundation for the industry. what is really key for us is that people understand where our various offerings can fit in. We don't want to pretend that all of our offerings are appropriate for all investors. What we want to do is say to investors, well, we have a suite of offerings. They occupy different places. These are the characteristics that our offerings have, and if we can clearly articulate that, then people can make the correct decisions for themselves.
Great. So a question for probably both Bradley and Victoria. Bradley, let's start with you with this one first. So nuclear is currently a red cross on your radar. Can you see a circumstance where you would consider nuclear as part of a greener future and hence included in the investable universe? And more broadly, do you see any nuclear-based businesses or stocks that you could invest in that are doing interesting things in the climate change space?
Sure. So in terms of the opportunity set, there's pretty much a dearth of public equity opportunities in the nuclear space. But broadly, to answer your question, we're clearly short energy, and we're clearly short energy that is not reliant on daylight and wind blowing in order to have robustness and backup within the network. And so I it's a personal view, but I clearly see that if we're going to progress towards, more EVs, more hydrogen-driven trucks, for example, we will require disproportionately more energy. And nuclear is a solution that done right, put in the right environmental and geographic locations, can have its roles. So I think what happened in the Ukraine is going to make folks, particularly in Europe, reassess some of their anti-nuclear policies.
And Victoria, often we say when we speak to people about web that to get to the solution, you need to get closer to the problem. Is there ever a circumstance where nuclear comes across your horizon and is part of the consideration for that sustainability challenge in energy?
So at Webb, we've chosen not to invest in nuclear, and part of that is more the structural challenges, I think, of nuclear. It functions well as a base load, but it's not responsive. You can't just turn nuclear up when you've got too little sunlight, or down when you don't need it so much. It's not very responsive. It's also the only fuel source that has a negative cost curve, so it's got more expensive over time, not less expensive. So nuclear already isn't perfect, and it doesn't necessarily work well as a balancing base load. There also hasn't been a lot of innovation in nuclear, and so I think where it could get interesting is maybe if you start to see more of that, and there are alternative technologies that address some of the challenges around the waste, around some of those cost issues, because at the moment it's not really competitive unless you have it sort of running all the time. So to put in new infrastructure that doesn't actually match the supply-demand imbalance, I don't see as a particularly sensible strategy versus investing in reducing the cost of things like hydrogen or better balancing loads. But I also wouldn't rule it out. I don't think it's helpful just to say labeling things as bad and good, I think is quite unhelpful. It kind of just depends, which is also unhelpful.
Yeah. Any on the floor? Anyone sick of listening to me ask questions yet? No, I've got plenty more here. So, Bradley, probably one for you. We've seen the Biden bump slow and even reverse course. Is real change just too difficult to achieve in practice, and how much has policy affected your investment decisions?
You may ask me to talk about US politics. I probably shouldn't. But I think one of the things that is become abundant and is really clear in the US right now is this extremely loose monetary policy has come to an end. And that really is going to have some profound implications for people's pocketbooks, for what housing costs them, for what their credit cards cost them. And I think that the people tend to vote with that. And so I think we will, heaven knows what happens in US politics. My only hope is that we can be less divided. And sadly, they look as though there are very few signs that is happening. So I think the tribal feud continues. However, I think these changes in the cost of living and families' budgets will potentially cause people to reassess how they vote.
Okay, this is a great question, and for Victoria. To what degree can capital invested via secondary markets, whether it's equity or debt, actually have a measurable impact given it's not providing additional funding for companies?
Yeah, I mean, hopefully some of the presentation slightly touched on that, but maybe it's worth expanding a bit on why. I think the key issue is the measurable part rather than the impact. And I think what the industry needs to do is be sort of quite humble about the scale of that impact. When we're engaging with companies, we need to be engaging together. There needs to be multiple people engaging with these companies, and the changes that arise from that might only be incremental. I don't think we can lay claim to all the emission savings that, say, Spirax Sarco's steam boiler has. That's not realistic. But can we potentially, as you were saying, improve their underlying footprint and reduce the negatives that they also have to increase the net positive? I do believe that is possible across the industry. And back to the sort of broader industry points, the financial industry has to be part of this change. It is not a separate entity to the world economy and the world's systems. And I think that's where our additional impact can come. But again, it's more likely to be incremental and has to be collaborative. So the hope that Webb can say this specifically was our impact, we created impact measurement reporting, that's unlikely, and I don't think that should be the aim, but it requires a bit of humility. It requires not being too territorial about it. And I think it's probably one of these things that can only be measured with data over time, looking backwards, almost with sort of data and analysis, rather than saying at the time we can do this measurement to show that this is what we did. And again, that comes back to having the data to be able to analyze. So a lot of it just comes back to better measurement and reporting and better understanding and better analysis.
Any on the floor? Brad, one for you. Is there a natural geographical bias towards Europe and China in the fund?
You know, we're nimble. We let the growth opportunity determine how we pick stocks, both at a macro and a micro level. Right now, we're in an environment where North America looks like the best house in a bad neighborhood. We're clearly, as I've been saying all day, very capital light in terms of most of our new industries. We seem to be navigating, you know, the effects of the war, the effects of trade issues, you know, notwithstanding that our gas price has gone up, that we are in a better point of departure than Europe or Asia. That's where we're at now. I think we're always data dependent and don't have a set view, and really hopeful that the reopening of China will rebalance Asia, and hopefully the war will come to an end, which would be very positive for Europe. So that's the status quo for now. Time and data will depend on how we evolve from here.
Adam, we see lots of responsible styles, particularly in equities and fixed income investing, but less so in alternatives and in infrastructure still. Is there any places in particular that you think more attention is needed in asset classes around responsible investing where it's not there yet?
I think the opportunities in infrastructure are phenomenal, actually. I think that, not trying to plug Macquarie in any way, but, you know, there are a number of investors who would include Macquarie in an impact, you know, as an eligible holding in an impact fund, because their fund's business is so geared towards renewables and has so much exposure there that it's phenomenal. So I would guess that we have a lot of opportunities in the impact space, in infrastructure. In property, we're also seeing a lot of opportunities for upgrading properties. It's, you know, the technology already exists to build new buildings that are more environmentally friendly, lower carbon footprints, etc. I think where the opportunity exists now is refitting existing buildings, because that makes a difference to the economics, the yield, etc. And from a basic, long-short perspective, we've seen investors going, long positive ESG strategies, short negative, etc. Secular trends often do, impose significant headwinds on those sort of strategies, but I still think that it's a nascent industry and we're going to see a lot of progress there.
Okay, for those who need to get back to desks for 2 p.m., we are going to wrap up shortly. Is there any more questions from the floor? One at all. Somebody. Oh, it's lonely up here. In your investment approach, how do you balance the need for resources for green energy versus environmental overall impacts? I think we'll give it to both of you, but Bradley, maybe if you want to go first.
Look, I think what we need is we need cheap energy, we need reliable energy, and that's paramount. Clearly, we all want to be green. We have to. I think it comes down to we need to set the bar in the right way that we can have commercially viable and capitalist positive ESG that is not a tax and a burden on these companies and encourages them to invest, encourages them to embrace technology, and where they can view ESG as their friend as opposed to a burden and a tax on their business.
Victoria, how are you thinking about green energy versus environmental overall impacts?
Yeah, I think we try to look at it as a whole and think about all of these problems as an interconnected. Climate is just one part of environment solutions. So when we're talking to our renewables companies like Vestas, you're talking to them about their land use and biodiversity and what the risks are on that front. Other companies who might be doing things around efficiency or more land use impact, you'd be talking to them about their fuel sources of their own sort of energy uses. So I think you have to look at it in a holistic way. And at the portfolio level, it's relatively balanced between those probably kind of clean energy solutions, efficiency type solutions. And I think ideally we'd like to see more opportunities in agriculture and land and biodiversity. But at the moment, biodiversity in particular is more of an ESG, the way the company is approaching it, the way it's having its impact versus a product that it's selling that addresses biodiversity. So I think there are a lot of things that we consider mainly on a sort of operational footprint perspective that we would love to see more solutions to, because clearly the companies need them because they're not addressing these challenges yet, and that creates an opportunity if companies have the technology and the products to service that need.
Okay, and that brings an end to Q&A and pretty much to today's event. We do have